Welcome to the Rust Belt Apartment Podcast presented by the Cooper Multifamily team, where we discuss all things multifamily with a focus on the Midwest's Rust Belt region. I'm your moderator, Peter Graylis, and as always, I'm joined by my co-hosts and teammates, Gary Cooper and Anthony DeMarco. In today's episode, we're joined by Steve Medinger and Aaron Massara of BlueMark Capital to talk money. BlueMark Capital is a full-service commercial mortgage banking firm with offices in Cleveland, Cincinnati, Dayton, as well as Louisville, Kentucky. They originate, close, and service a loan portfolio in excess of $1.4 billion. In addition to having a CMBS and agency relationships, the company exclusively represents more than 20 life insurance companies for the placement of commercial mortgages in the Midwest and maintains capabilities of closing businesses throughout the United States. In addition to permanent fixed rate loan products, BlueMark actively offers consultative services for commercial real estate industry, including construction financing, equity capital, and credit tenant financing. Steve Medinger's career spans over 30 years and has earned and established him as a well-known and credible source for delivering commercial real estate and equity solutions for all forms of real estate development. Aaron is an associate in the Cleveland office. He's responsible for aiding in the origination, underwriting, structuring, placement, inspecting, and closing of all property types and structures. Aaron joined BlueMark in 2018. Steve and Aaron, welcome to the podcast.
Hey, here. Good morning.
Thank you so much.
Glad to have you guys. Glad to have you guys on today's episode. Thanks for making the time. Steve and Gary go back quite a while here. So Steve, we appreciate you taking the time to jump on with us and just kind of talk, talk money, talk the state of financing in 2022.
And that was sort of the setup, right? Steve and I go back to, before the Tax Reform Act of 1986. So when you see these, handsome mugs on there, we are not 25 years old anymore. But the important thing is that I think, and Steve, it's going to be an important thing for this conversation is that, not only did we go through the crazy syndication build up and the oversupply and the Tax Reform Act of 86 and the savings and loan crisis and, the dot-com burst in 9/11, the Great Recession, we've seen multiple cycles through this. So, what we wanted to really accomplish with you gentlemen today was to really talk about the true state of the market in terms of financing. We all hear the cocktail party talk of what's going on and how great it is and yada, yada. So, what we're promising our listeners and viewers is, again, no fake news. What in the world is really happening with financing right now? And it's a key component of obviously what we do and certainly what you do.
Gary, I think that's a perfect segue into our first question. A pandemic, now a world war with global implications, yet nothing has slowed this market down. We're on one of the longest bull runs in recent memory. Do we see a correction? Is it the roaring 20s? Is it the inflation 70s? Assuming multifamily is the preferred asset class for investors out there, is it really this easy? Has it been this easy? How is the environment changing from a money and financing standpoint? I threw a lot at you, but I think
that was a lot of questions, Peter. I think I'll let Steve jump into this a little bit, but again, all the things that I sort of talked about before, the Tax Reform Act of 86, the savings and loan crisis, the dot-com burst, 9/11, the Great Recession, all of those had dramatic effects on not only capital and the flow of capital, but pricing, activity, transaction activity. I think the most unusual thing, and Steve, I was on panels probably with you back in 2015, 16, 17, when everybody was asking, what inning are we in? Because we are so far into the thing, right? We're the bottom of the seventh, top of the eighth. Now we're in the 26th inning of this thing. But, the biggest thing that I've seen is that despite all these headwinds, we've seen zero pushback in terms of buyers. We've seen compressing cap rates. We've seen, interest rates obviously fall to record lows last summer, but I've never seen in 38 years, I've never seen anything like this.
Well, I would agree with you, Gary. And, we just got back from our annual Mortgage Bankers Conference about a month ago. And again, it's, I think 10, 12, 13 years running where all of our lenders said we had a record year last year. We're going into this year with the same amount of money or more money. And most of them all have a larger allocation this year. And they're all expecting to do the same type of business. And to your point, I mean, we've been saying it for 12 years now. Is it going to stop? And it just keeps going and going. And we've got, all of our lenders are trying to figure out ways to skin the cat and be competitive with one another. Interest rates are still low, even with the treasuries that have moved up a little bit as of late. We're still getting deals done in 3.5% to 4.25% range right now. I don't see it slowing down. Some of the product type might slow down a little bit, but multifamily, industrial, they're full steam ahead.
Steve, in terms of some of those loans that you're talking about and those rates, what types of programs are you seeing? Are these agency? Are these life insurance loans? Is it a mixture of it all? What's different between them, between the two different product types, I guess?
Well, and it's a smattering of all. It's banks, it's life insurance companies, it's agencies. It's debt funds, it's private companies. We've been able to do land loans, we've been able to do acquisition financing, we've done some development loans. It's truly across the board. Our primary focus in the last few years has been life insurance companies, and we are getting multifamily deals done with them up to call it 75% financing. If we provide them lower leverage, they will provide you a very, very favorable coupon. So that if I quote you a 375 rate at 75%, if we say, well, we'll give you 60% leverage, we might be 50 basis points below that. So that's kind of how they're trying to, I don't want to say buy the business, but be more competitive.
Good question, Anthony. How are you guys even approaching underwriting deals, right? We've got record rent growth, subsequent record NOI, but we've also got, some record inflation. We're in such an interesting point right now. A deal comes across your desk, what's the stress test?
Yeah, I think it's a great question. Steve and I were talking the other day about stress tests and historical stress tests relative to what stress tests look like today, to really measure for inflation, to measure for, the fact that gas is, pushing $4.25 a gallon. The economic effects of the world that we live in today are broad and vast. And how do you account for that when you're underwriting a 200-unit multifamily deal? It's hard to distill. I think the common stress tests that we've always seen have been a 5 to 10% vacancy number, depending on how conservative, you really want to be as a lender, the market, how competitive other lenders are really being for that particular asset or that product as well. So some kind of standard vacancy number could be as low as 3, could be as high as 10, could be actual vacancy. A management fee of 5%, 4%, 3%, some kind of standardized management number. Some kind of replacement reserve, I think, is another stress test. So those are the real, micro stress tests that, again, we'll use in every single underwriting. I think on a more macro level, cap rates are huge. And you don't really think of a cap rate as a stress test, but based on in-place cash flow, we're seeing deals trade at sub 5, sub 4
Sure.
caps even, here in the Cleveland market, which isn't all that historically comparable for us, at least, financing some of these multifamily deals. And so to stress test, these assets trading at these below historic cap rates, we're using a 6 cap, a 5 cap, maybe, I don't think, Steve, correct me if I'm wrong, I don't think we're really going below a 5. And I don't think in Cleveland, Ohio, or in the Rust Belt in general, our lenders want to go sub 5. but capping, or I guess flooring a cap rate, is another stress test.
Mhm.
And using in-place cash flow in general is a bit of another stress test, because a developer can come in and think they're going to bump $1.5 million NOI to $2 million year one. But if the property's been performing at $1.5 million for the last 8 years, and we have a historical trend that's flatlined and is pretty linear at best, it's not parabolic, it's hard to assume, or at least stress test assume, that again we're going to go parabolic on NOI. So those are all factors that play into each individual underwriting that again makes sense logically when you talk about each individual one on its own, but pool all of them together. And Steve and I try to strike the chord between hitting the dollars, hitting the coupon, hitting the financing that obviously our borrowers need, and making sure these stress tests are accounted for with our lenders.
Well, and it's funny you bring up, in the past, when we talked about stress testing deals, it was like, oh, you're getting a coupon rate of 5% coming in, can this deal make the debt coverage at 6.5? Now what we're talking about is almost a completely different animal. Like I said, as Peter mentioned, we had 10.3% rent growth last year in Cleveland, Ohio. And there was, 20 markets better than us, but, we're seeing, refrigerators cost 28% more if you can get them than today. Turnover costs, so even if the inflation marks 7.5%, we're seeing, exponential numbers in terms of what that is. And it's just, I haven't seen this environment for a very long time, probably since, Steve and I were walking 6 miles in the snow barefoot to school, unlike you kids that got dropped off right at the doorstep. But, we were also making deals work at 16 to 21% prime rate. So when people start kind of saying, oh my God, Fannie and Freddie are at 4.2%, it's almost a little bit of a joke. And in terms of interest rates, right, we've heard the Fed's going to be increasing 6-7 times this year, 4 times, 3 times. What are you guys projecting? What's BlueMark projecting? And how are the lenders looking at those rates going up?
Well, you want to guess some rates, Aaron? We were just talking about it. Obviously the Fed's they're going to bump the key treasuries, move them up a little bit. And I think that, we've talked to some of our lenders. I think the 10-year treasury kind of a target in mid 2s is what we think we're hearing. So, maybe 50 basis points higher than what it is right now.
I mean, end of last year, we were what, 130, 120, 140 on the 10-year. And a year before that, we were 50 basis points, 60 basis points, mid 2020, mid COVID. And today, well, not today, backing up a couple months, we were pushing 2. I mean, I think we hit 2, just over 2 on the 10-year, before there was a war going on. And now over the past week, I think we've gone somewhere between 20 and 30 basis point swings every single day. And it's up, it's down, it's sideways, but it's rarely the same, 2 days ago or 2 days in the future from what it is today. And how are lenders combating that? I mean, we've seen lenders just completely say, we're not going to quote business right now. We really haven't seen that since 2020. But depending on how crazy these swings can get, some lenders might just take a day, a week, 2 days, 3 days off from quoting business. Others might just quote pure coupons. And I mean, Steve, correct me if I'm wrong, I think we're probably seeing that more so than we're seeing spreads, over these treasuries being quoted today.
No, there's no question. And the life insurance companies, they are saying they're going to quote up whatever, 3.5, 3.75, 4% coupon. They're going to sign up the rate and they'll take an application and they're going to fund the loan. In comparison to the CMBS world, which is, they're kind of going crazy right now with what's going on with these rates. They don't know that as you know, they don't lock rate until right before they close a loan, and they just don't know what the bond market's doing. And I think their spreads are probably up 25 basis points in the last week, and they don't even know what they're going to be able to get done at this juncture.
Yeah. And I mean, guys, you pull anybody. I mean, these life companies, whether it's a State Farm, it's a MetLife, it's a TIAA, American Equity, you pull any of them, You pull any agency lender, you pull any CMBS lender. I mean, they probably tell you that we're not even through the first quarter yet, but the first quarter of this year, they probably saw every bit of double the production from the previous quarter, let alone,
Wow.
I mean, they probably saw half of last year's production in almost the first quarter of this year. I mean, that's kind of how hot we rolled from 2021 into 2022. And because of that, everyone's just selective. I mean,
do you think this is all about, people refine their, finally seeing that, hey, rates are going to be increasing. So I'm going to lock in, do I lock in now before I lose that magic number?
Good question.
I think there's some of that. I think there's still just so much product out there. And I mean, the markets are just, they're frothy from coast to coast, and people are still making deals. And, if you can get money at between 3.5% and 4.5%, to your point earlier, Gary, I mean, we've seen deals get done at, 10, 12, 18%. A 4% rate is a very, very good rate. And you can make a lot of real estate deals with that coupon.
Let me ask you, these guys that are running to refi right now, I mean, are they really signing themselves up to put themselves in a position that in the next like 3 to 5 years, they're going to have a hard time getting out of those loans? Like we've seen now on kind of the CMBS loans of the call it the 2013 to 2016 swing, right?
Yeah.
A lot of the objections that I've experienced, right, is just, how can I get out of the prepayment penalty or the yield maintenance premium? So I mean, what are some of those looking like? Are they the same? And are people do you guys see people struggling dealing with getting out of those loans if we do continue to see a market where people are continuing to come in and compress and people want to maximize their value and completely exiting the asset?
I don't think we're having issues from deals over the last few years, last, call it 10 years or fewer, simply due to what Gary said earlier. I mean, the rent appreciation, the rent growth has been huge in our market. And, as Steve even said, across the country. So, I mean, as rents have really appreciated, even in spite of the inflation that we're seeing, I mean, the market makes no sense today. I mean, as we live and breathe, the market makes absolutely no sense with, 7.5, almost pushing 8% inflation, rents appreciating, as easy as it is to get money and as cheap as it is. I mean, we're moving, up is down, left is right. Like we're moving in all kinds of different directions. And I think to your point, it's only going to get harder from here to get out of some of these prepayment penalties. Granted, yield maintenance is going to look more attractive as rates rise. So that is a pro. Despite that, despite the increasing rate environment, I think that as rent growth appreciation maybe slows, maybe inflation kind of catches up to us, it's going to get a lot harder moving forward, financing deals today to get out, again, at a sale, I mean, how low can cap rates go? Again, it's just, we're going to hit a breaking point. It's a matter of where it is and when. And I think typically, at least historically, our markets are a little bit behind, certainly those on the East Coast. So, we can at least have the benefit of looking towards the coasts for trends that we can expect to see in the coming years.
Well, and this is going to tie into Anthony's question a little bit, because I think he was going in this direction. And, it's that two word kind of thing that we hate. And it's not FU. It is yield maintenance. And so you look at, yield maintenance has stopped some people being able to sort of take advantage just because they're looking at 30 to 35% prepayment penalties because of where they were in terms of that loan value. Now, certainly in rising interest rates and some of these other things, who knows? I guess you could be in the money too on yield maintenance or all of a sudden a loan at today's rate in a couple of years might look like a super attractive rate. Sure. Which really, I guess my question out of that, rather than just that statement or observation, is, what are you guys recommending to your clients right now, right? There's 5-year, 7-year, 10-year, Fannie's got 13.5 year, the life companies are self-amortizing over 20, 25, 30 years, whatever you set it up at. What do you guys obviously I'm giving you a very generic thing because, it would depend on the circumstances of the borrower and the property and such. But, where do you think the sweet deal is right now in terms of balancing rate and term and yield maintenance and all of that?
Good question.
Well, it's kind of hard. I mean, it's such a deal specific question.
Yeah.
And I mean, we've
Sure.
got, Aaron and I are doing an acquisition loan right now, which is, it's some 7-year money. We've got lenders who will do 3-year money, 5-year money. If somebody is buying something and they think they're gonna, see rent growth over the next 24 or 36 months, we'll give them a 3-year deal or a 5-year deal. We've got some interest only product where they can, and some of them even have, lesser prepayment penalties on some of these shorter term deals. I mean, we've got folks doing 5-year deals, 10-year deals, 15-year deals. Some of the life companies are even doing 30 and 35-year fixed rate mortgages, which is an awfully long time. And so really, it's, as I said, it's very deal specific, and it boils down to what they think they're going to do with that asset. So we can really offer them anything that they want to do.
So I guess there's some truth to what Peter was mentioning about easy money, in the sense that, you have a smorgasbord of options today, whereas in, many times in the past, right, Steve, I mean, you better fit into this little box, or here's the program that's available, not, this wide of a array of options.
You're exactly right. I mean, we can, we can almost finance any property type, and we can give you whatever term and duration you really want. We can find a box for you.
And Steve, maybe this is a nice segue, and just a quick high level intro. And there's probably a lot of listeners that are curious about this anyways. And at least from my experience, I don't hear a lot of people talking about the life company option. We hear a lot of, obviously the bank option, and we hear a lot of the agency, the Freddies, the Freddie small balance, the Freddie loans, the Fannie loans. You don't hear a lot of people, at least on the acquisition side, in my experience, looking into that that life company option. Can you talk about that a little bit? Because it is, from at least what I've seen, and times that Aaron has sized up deals that we've looked at, right? It's always such an attractive option that I think everybody should be looking into.
Aaron, you want to take that?
Yeah, I think with a life company, you're going to get, like, let's just, put everything out on the table and kind of, spread them out and compartmentalize. I mean, you've got your agency, you've got your bank, you've got your life company, you've got your CMBS, you've got your debt fund, your bridge. I mean, every option's on the table. I think with a life company, you're going to have far and away the easiest execution. And, from the smallest developer to the largest, I don't know a developer or an owner where that doesn't matter. I mean, that doesn't, factor into the process. So easiest execution. I think you're probably at this stage of the market, probably going to have the lowest coupon as well. I mean, I know life insurance companies are certainly lower on the coupon front than CMBS lenders, banks, and they're obviously going to go longer term. So, I mean, that's kind of the third fold of it. I mean, as Steve said, and Gary, you alluded to this too. I mean, self-amortizing deal, you want a 15-15, a 20-20, fine. You want a 10-30. You want 10 years of IO. I mean, our life companies can do it. I don't think that many associate life companies with the capabilities they have today. And maybe that's just the disconnect. Anthony, to address your question, I mean, do borrowers and, again, developers, owners know that they can get 10 years of IO from a life company? Maybe not. I mean, do they know that they can get to 75% leverage on an acquisition or a refi? Maybe. I don't know. But I think a lot just plug the deals into their model that they've done previously, and maybe just don't step outside the box and figure out, what else might be out there. But that's where we come in. And I mean, we love the education process and, again, just kind of spreading the wings.
Aaron, can you put a percentage on the amount of life company deals you did last year? Just to give folks an idea.
Yeah. I mean, I would say between our office, our Cincinnati office, and our Dayton office, I mean, BlueMark Capital as a whole, I mean, Steve, we probably did every bit of, I mean, I think we're averaging 50 to 60% life company deals.
Yeah, I'd say it's,
yeah. I think beyond
60%.
Yeah. So
60, Steve, huh? Okay.
Call it 60% life company, which, again, I think historically it's right around there. And then the rest is just a smattering. I mean, maybe it's, 15% agency, 10%, call it CLO, alternative lenders, bridge, debt funds, whatever it is. CMBS is generally a smaller portion of I think our originations, just because it, for all the obvious reasons. And then banks. Yeah.
Speaking of that, and I know debt funds have taken an increasing importance, especially in the financing of multifamily, and you sort of mentioned them as well. That seems like a pretty flexible product compared to the agencies. Is that what you guys are seeing? And how are they differing versus the more traditional sort of agency life deals?
I think the biggest thing that you're going to find, or one would find, with debt funds in our market is that it's tough to get some of these debt funds to play, because most of them, not all, but most, have a minimum loan size plus or minus 50 million. So, you're talking, 50 million to 500 million. That's kind of their strike zone. Whereas, we're not that kind of market. We're not a New York, we're not a Boston, we're not a Chicago yet, hopefully. But we're just not there, today. So we don't see debt funds play much. We do see debt funds play a lot in the mezz of a capital stack. It might not be more than a $5 million mezz slug, or 2 million or 10 million, but we see debt funds play a lot there. But just a pure, let's provide the full capital stack.
Yeah.
We don't see them tons. I think they play well because, again, they can usually go up to, in some cases, 80-85% of the stack, because they'll provide a 60, 65, maybe 70% senior piece followed up with a mezz piece, 2 different coupons, full stack. And that's how they'll provide, again, call it 85-90% of the full acquisition price or development cost.
Yeah, that sort of leads to 2 questions. I'll start with the first, which is, again, you brought up mezz lending. And again, it's crazy because last year we heard mezz lending, it was in the 4% range for mezz product that was out there, which, again, usually when we thought of mezz, we thought of hard money lenders and, crazy, points on the way in, points on the way out, crazy interest rates. But, and I don't know if it's because these debt funds are involved, we've seen some pretty attractive bridge and mezz kind of financing in the marketplace. Are you guys still seeing that? Is that sort of tightened up with some of the unusual events that have happened? And what do you see for the balance of this year?
Well, we've done several, value add bridge type acquisition loans, which have been 4.5% to 5% type thing. And Aaron, you speak to this if you would, but I think the mezz that we're seeing, we're not seeing mezz at 4%. I think the most of the mezz we're seeing is, 6 to 8, 9% kind of range. Is that about right, Aaron?
Yeah, I think depending on that last dollar, okay, I'm the mezz lender and I'm coming in and I'm filling the gap from 80% to 90% of the cap stack. Well, I'm going to get paid a little bit more than a lender that's coming in filling 70 to 80. Where that last dollar hits really drives a lot of the coupon. But as Steve said, we've done quite a bit of the value add bridge business, over the last 24 to 36 months. The coupons of that have really mirrored, especially for, nice workforce housing, have mirrored life companies and agencies. A bridge loan, 80% of someone's acquisition price followed up with 100% of the CapEx, green efficiencies, everything a developer wants to put into that property is at an interest only coupon of, 3.5% to 4.5%. It's hard to go wrong.
Yeah, no, it's crazy. And the second part of my question ties back to what you guys were saying at the first, because you were talking about debt funds, not only because of the size of it, but just, obviously Northeastern Ohio. Obviously, the title of our podcast is Rust Belt. And, 20 years ago, even 10 years ago, that would have had a very negative connotation. Like, why are you using that? Now we think it's a big positive for a lot of reasons. But certainly, Freddie and Fannie have adversed, right? We were redlined for a long time. How are the agencies, how are the life companies truly looking at Northeastern Ohio? We've got, an influx of capital from all over the country that's looking at our market as being undervalued, that there's a lot of low hanging fruit, that, yields are going to be better here, but how is the financing market truly looking at, Cleveland, Akron, Canton, And are we, still made fun of, or is it like, hey, this is a place where we can solidly put money?
I think that all of our lenders think that they would be very comfortable putting money into these marketplaces. And there might be a handful of real large debt funds or life insurance companies that are going to still poo-poo Cleveland. But for the most part, 85% of our lenders, they love this marketplace. And, they're not having to chase 3.5 cap rates on the coast, and they're not having to compete, with 20 other lenders on the same deal. Sure. And every one of them is very comfortable. And in fact, we've got some lenders who really like going down into the Akron, Canton markets because there's even less competition. So, we finally have come around where people really want to lend money here.
Yeah. Speaking of, I know certainly Canton and maybe this is just refis with Freddie and Fannie, it's a lower LTV. Are you seeing, again, the Cantons or Akrons adverse in terms of LTV or rate or anything right now from the various sources?
I don't think with the life insurance companies, I think we'll still, even on, smaller, $2 to $10 million product, we can find small life companies, even on B quality assets, who are going to take, multifamily lending up to 75%. I think the agencies, by virtue, and Aaron could speak a little better on this than I can, but, they sort of put everything into their model, and, the Akron and the Canton and some of those tertiary markets may get a little bit of a penalty from them in terms of maybe a small increase in rate or a decrease in loan to value. But for the most part, the life companies are, we're right at 70-75% in all these markets.
Yeah, I think that's exactly right. I think that the box is grayer in a positive way with life companies, because Steve and I BlueMark, we're correspondents for a reason. These life companies are sitting in Omaha, Nebraska, and Chicago, and they're all over the place. They don't know our market like we do, and so that's why they rely on us to tell the story of North Canton or Montrose, whatever it is. Whereas with an agency lender, it's a little bit more empirical. You go over to the mid-market column, you follow it down to the 10-year row, and your rate is plus or minus that, depending on your green efficiencies and your affordability criteria that you're meeting. So it's more empirical from an agency standpoint, and maybe that leads to 75% leverage versus 80. Steve financed just last year a 75% loan to value life company deal in Akron. So it's, we can tell the story with our life companies. They get it. They're big picture focused. Nobody gets multifamily, of course, better than agencies, and they have their formulas for a reason.
But I think that really sort of, emphasizes why BlueMark Capital and, you guys, again, are local. You're based here in Cleveland. You understand the marketplace, and obviously because we've got folks bringing in capital from all over the country, they're also bringing in mortgage brokers from all over the country. And you got to sort of explain where Cleveland is and Akron and so forth, other than the, former home of LeBron James kind of thing. That you have, and trying to explain them. To give you an example, so somebody went to a large firm that's based up in Minneapolis, a mortgage banking firm, and of course, they're trying to refinance a property in Greene, Ohio. And as you guys know, Greene's a fantastic sort of community, growing community, great demographics. The property was very solid. It was going to go into a small balance deal, but it was crazy because they were 70% on the LTV. Then you go to a sort of troubled property in Garfield Heights, and we get 80% because of, it's like, Greene is tertiary, so we've got to adverse. We can only do 70% on the LTV. It was difficult, unfortunately, the borrower had to accept that because, I'm seeing guys like both you that can basically say, Greene's better than Garfield Heights. And your loan is just, so again, and you might have the product, again, life company product or something where people can do that. But we're still seeing a little bit of, that, national thing, like you said, Aaron, just, they plug it into the model and it's like, oh, here's what it says, kind of thing. So, there's huge value that we see, in firms like yourself, specifically, and being able to provide advice to people looking to invest here.
It goes both ways. I mean, to a huge degree, because I mean, the three of you are, in our minds, the best of what you do in Cleveland. And I think when we have questions, which we often do, I mean, Steve and I just did this morning on cap rates, I mean, on in-place cash flows, and, you know, where some of these deals are just trading these days. I mean, you know, construction costs per unit, values per unit, whatever it is. I mean, we enjoy the partnership. We enjoy turning to you guys. We know that we're going to get an honest answer that's based on just historical data. And it doesn't have to be over the last, you know, Gary, sorry, you know, last, you know, however many 40 years since 86, you know, it could be since, you know, it could be since 2000 and, you know, 20, when obviously things were a little wonkier than they are now. I mean, we just kind of, we need answers. And I mean, not to completely turn the tables and Peter, take your headset over, but I mean, from a cap rate perspective in Cleveland, and Steve kind of touched on this with our lenders who, you know, do enjoy not chasing, you know, crazy compressed cap rates. From a cap rate perspective and from an in-place cash flow perspective, I mean, what are the three of you seeing in the Cleveland market relative to what you've seen over the last few years?
Yeah, and that's a great question, Aaron. And we're seeing that cap rate compress. And a lot of that was, if you guys remember, sort of last summer, right? You know, we were seeing sub 3% interest rates, and you're looking at a 10-year deal. So if you have IO for 10 years and a sub 3% interest rate, you can buy a 3.5 cap, and you've still got positive leverage, right? And you're producing a 5, 6, 7% return, even at a crazy cap rate. We're seeing a little bit of a bid-ask disconnect right now, because of course sellers, you know, they're in the marketplace are like, what do you mean you can't get me a 4 cap? And again, we've got, you know, folks that own, you know, the BC apartment product, that's our specialty, the workforce housing product, that all think, you know, sub 5 caps normal now. So we've seen that sort of move into the marketplace, you know, and it's getting a little bit more difficult because again, you know, we're seeing a little bit of pushback for the first time in, you know, and probably 10 years. We're starting to worry about appraisal values. You know, we haven't had to worry about, you know, something actually appraising for quite a while. And, you know, even sellers and buyers are like holding their breath a little bit. As you wait, Jesus, the 4, 5, 6, 7 weeks now on appraisals, what it's taken, right? We'll talk a little bit about timing for loans and third parties, but you know, I think the fundamentals are there. You know, so even if you look at sort of these record low cap rates in Northeastern Ohio, you know, I think there's still, you know, you still got, you know, great rent growth. I think, you know, you've got a supply constricted market. Yeah, there's a little bit of building going on in the CBD in Ohio City and so forth. But again, that has little to no effect on most of the apartment product. And, you know, I still think there's a very rosy future. And I think still, you know, 70% or more of your return here in Northeastern Ohio on your IRR is cash flow. And the great thing about cash flow is you control that. It's not subject to the market. It's not subject to interest rates. It's not subject to somebody coming and paying more money than what you put, or cap rates compressing. So, you know, I'll let my partners talk a little bit more about that. But, you know, we're extremely bullish on the apartment product here in Northeastern Ohio.
For sure. And I'll jump in and just touch on rent growth, right? I think that's something that's so important to talk about, because I think that, you know, from a big picture, we keep hearing that, you know, we've hit record rent growth levels. Gary even mentioned that we surpassed 10% in rent growth last year. But like, just from a big picture, I mean, I just think that we've only like kind of tipped the surface with that. And I say that because of the individual conversations that I have with, you know, owners in this marketplace. And, you know, when they're leaning on us to the same degree where they're saying, you know, hey, you know, help us understand what this market really looks like, because it's a little bit of a different world for them, where they can raise rents, you know, $50 and have, you know, zero turnover issues, have, you know, no pushback. And they're like, you know, I've owned this asset for the last 10 years and that's never been the case. So, you know, how much can I actually push, right? And we're seeing that, you know, you know, almost they're out producing or even the levels that we're telling them, like, hey, this is probably the ceiling. on where you could push without recreating the wheel or putting in some sort of like luxury packet, kind of fit and finish. And they're calling us back and they're like, we did that, and then the following week we raised it $25, and we're still not getting any pushback. And our neighbor just raised $300, and now we're getting their tenants, right? And so again, I just think that as we continue on and as people continue to see that they're able to start raising rents and again catching up to the rest of the country, if you will, I think that we're going to continue to see levels of rent growth. Even through some of the inflation issues that we're going to kind of have to navigate through. Just for example, I think right now, if I ask the average person, how much does a turnover cost? If you're doing a full turnover, and again, not anything crazy, just your normal turnover. And what we're hearing is, it's costing $7,000 to turn a unit now. Where that probably cost that same turnover, even in 2018, probably only cost $2,500, maybe $3,000 at most, right? And now those basic turnovers are costing $7,000. We're seeing people that believe enough in this market that are coming in and are paying or are spending $15,000 to $20,000 to improve their units. And so, again, rent growth and rent increases are going to come with that, and people that aren't necessarily spending that $20,000 per unit are still going to have an opportunity to close that gap. So, in my opinion, with all that being said, I think that we're just at the beginning of what this market's going to show in terms of where rents are actually going. And the influx of the capital coming from the different markets are only helping that, because like Gary said, 5 caps now for workforce housing products normal. So is $850 rents. So that's my opinion.
Well, we spoke to an owner yesterday, Class C in Cleveland, that on renewals at the building was pushing $100 each renewal. Zero pushback. They've been doing this over the course of the last, I think she's been doing it for 3 months now, if not longer. And on their new leases, it's closer to 150, 175 increases across the board. And these are organic increases. These aren't LED lighting, a concierge, and an Amazon package room. This is just organic paint and carpet.
Yeah, and just sort of close. So we're bullish. I mean, again, I'm sort of mentioning, hey, have we sort of past, I think we're on the other end of the bell curve of peak pricing. A lot of that has to do with, again, we're not seeing 3% interest only for 10-year financing. But again, that doesn't mean we're not a great buy still moving forward. I think, again, there's, as Anthony said, despite how much we've moved, we're still not, we're just normalizing now. Steve, for most of our careers, like you said, we were adverse. The area was looked down upon, laughed at. We were so far behind where things were that now I think people are sort of appreciating all the things that we have in this region, in this area. And, we're playing catch up, and we've got a long way to catch up, because we've got a long way to go, which means, again, somebody buying into this marketplace today, I think, again, is making a very solid bet that pays off quickly without the risk that you have in a lot of these other markets.
Agreed. You briefly mentioned that we wanted to get into timing. We want to chat with the guys about deal timeframes and third parties, the entire transaction process.
Well, let's talk about the thing that's most important to me. I'm the broker, right? Because it's like, hey, how quickly is it to my paycheck?
Yes.
It comes, then it's like, hey, from start to finish, from app, or how long is it taking you to get the term sheets? Do term sheets even matter anymore? How long is it taking? Obviously, we are talking about, we used to have the 2-week appraisal turnaround, and that's a thing of the past. Now it's 4 weeks if you know the appraiser and the firm and can provide some heat on them to turn it around. But what's a realistic sort of time frame, because me as the broker, I'm going to be pushing the buyers, hey, close in 30 days. Clearly, I'm hoping you're going to tell me, hey, we've got that product, we'll help you close in 30 days. But reality says it might be something a little bit different.
Yeah, we don't hear that too often. What do you guys
Steve,
have?
you closed a land deal in how long? 15 days?
Yeah,
2 weeks?
in less than 3 weeks, but
Wow.
that's not the norm. But I think if we have to close something in 45 days with a life company, we might be able to get it done, but we have to be hitting on all cylinders, and everybody has to be prepared to do that. It's typically a 60-day deal from, kind of app to close. The third parties are taking a little bit longer. I mean, we're getting appraisals done in anywhere from 3 to 6 weeks, again, depending upon, who it is and how well we know them, that type of thing. And if, we could probably even get something done in 30 days, but, it's, like I said, everybody has to be, clicking on this on all cylinders, and, third parties have to already be in process or engaged, or they're already there. And so.
Sure.
Yeah.
But that's perfect. That's exactly what I wanted to hear, because I'm going to tell them all they lost their mind if they want more than 60 days on my
That was a setup, Steve.
Yeah, Gary, I would love to tell you what you want to hear. Unfortunately, this kind of harkens back to what we were talking about earlier. These life companies, these CMBS lenders, these agencies are just doing the quantities of business that they haven't done before, and they never really conceived of doing at this point. So particularly when they're giving, a borrower this menu of term options and, 3 years to 10 years of IO, whatever the case is, they are going to push back at a point. And it's usually about timing to say, hey, we've got a fuller than full pipeline. Our pipeline's actually oozing, it's so overfilled right now. So there's just no way, with all the manpower in the world, and most are somewhat limited, if not, maybe coming back to full strength with COVID and remote and all that.
Sure.
With all the manpower in the world, we can get this done in, 60 days, but not a day sooner. And unfortunately, we just can't sign the deal up if, it needs to be done quicker than that. I mean, we are hitting those types of walls that aren't arbitrary. I mean, you're just asking people to do something that they can't possibly do. And it's not even about third party timing, or it's not even about, when does the PSA amendment come out? It's, when can Steve and I get a commitment, because we can get, X lender's eyes on the full write-up that we've done, when they have 50 other approvals and, 12 other closings today.
Sure.
Yeah.
Sorry, Gary.
Oh man. Well, 99% of what we talked about, I think, has been great. It's been great for the apartment product. And if I have to wait an extra 2 days, I can wait an extra 2 days for that. But again, I heard Steve Medinger say 30 days. So
It's gospel. It's gospel now.
And that is right, because Steve is the man. So Steve says 30 days.
That's actually going to be the title of this episode is BlueMark can close in 30 days, guaranteed.
No pressure. So go ahead, Peter, if you want to wrap up.
Awesome conversation. I think we touched on a lot of my notes here. Anthony, Gary, I'm not sure if you guys wanted to touch on anything with the guys.
There's probably one last thing, maybe the last subject that I wanted to sort of broach, which is, obviously, we're multifamily guys. This is a multifamily podcast. We've been talking multifamily. We've been heard how, we're the favorite asset class and we're the, favorite son and everything else. Is that true? I mean, you guys do financing in all, all different product types. You guys are strong in retail and office and industrial and, single tenant and so forth. How does multifamily compare to that? And is there anybody else really that's on that same sort of favorite class, or is that just, again, my wishful thinking that we are the
I think
Good
Steve
question.
can speak to this better than I can. My personal opinion is that the prom king is probably industrial and the prom queen is probably multifamily. And then I think there's, a bit of a pause, and then maybe there's self-storage and, who knows what's really happening with office and retail, though we're getting a lot of it done. But I certainly think 1, 2 are, industrial multifamily. Industrial, for the obvious reasons, is can be a little bit cleaner sometimes. A big 250,000 square foot, Amazon center with Amazon on the lease for 20 years. It's
Sure.
pretty easy for like a very busy, loaded life company to get behind and underwrite, get through their approvals versus a, 450 unit, class A high rise. So, that's the 1, 2, but you're there.
Okay. I can take being the prom queen, I guess.
Well, some of our life companies have done so much multifamily in the last few years that their portfolios are really tipped and heavy in multifamily, and they're looking to the industrial and some of the other product types just to balance it out a little bit. But yeah, I agree with that. It's multifamily and industrial, definitely the top of the heap.
Fantastic.
Guys, thank you so much. Appreciate the time. BlueMarkCapital.com is where you guys can visit to find a little bit more about Aaron and Steve and what they do. Guys, best way to contact you both, email, phone, any parting words or anything you'd like to leave with us before we sign off.
All right. I appreciate the time. Thanks for having us.
It's our pleasure.
Yeah. Email us, text us, call us, send us a pigeon, whatever it takes. We'll be here. We'll answer the call. And as Steve said, we really appreciate it because, again, this just feels, you guys are some of the best, and we are grateful for the conversation and the recognition and all of it. So thanks very much.
Awesome. Hey, it's our pleasure. Listeners, viewers, we'll be sure to leave Steve and Aaron's full contact here with any posts on the show. Thanks for joining us. As always, my teammates, Gary and Anthony, thanks for your efforts today. Till the next episode.